This first session will provide an overview of the Chinese economy. In the further two sessions this week, we'll be looking at the Australian economy, followed by a review of the Australia-China bilateral trade and investment relationship as it stands now. Subsequent weeks will allow us to look in more detail at the trade and investment opportunities that may present themselves going forward. With a population of 1.4 billion, China is the most populous country on earth. Contrast that with Australia's population of around just 22 million. China's landmass, meanwhile, is about 1.2 times that of Australia. The capital city of China is Beijing. Its currency is the renminbi, and the unit of currency is the yuan. Prior to 1978, China was run as a centrally planned economy. What this means essentially is that all product prices were set by government, with output and production levels determined by an overall government plan. 1978 then was the beginning of the market reform process, the so-called open door policy, which was initiated by Deng Xiaoping. What we witness in China today, therefore, is the result of just 35 years of reform, an amazing testament to how successful this reform process has been. The reform process itself was a very gradual and cautious one. Deng Xiaoping's dictum was, "You cross the river by feeling the stones." Translated into practice, this meant that economic reform was initially restricted to certain geographical locations in the country, in particular along the southeast coastal area, from Guangzhou northwards. As part of this approach, special economic zones were established to allow for restricted entry of foreign companies. In this way, authorities hoped to manage the expansion of the market economy and to ensure that it was best adapted to the Chinese conditions. Market socialism, as it is known today. Again, to quote Deng Xiaoping, "It doesn't matter if the cat is black or white, as long as it catches mice." So what we have in China today is a hybrid economy, a mix of the old and the new. The state-owned enterprises, which the government is looking to modernise and make more efficient, and a nascent private sector, very innovative but somewhat constrained. Slide, the bottom half of the facts. So just how far has China come? A few bold observations underscore the extent and also the scale of the Chinese success story. Certainly, millions have achieved a better life over what is a relatively short period by any historical measure. And as incomes have risen, China has embraced consumerism and technology. But at the same time, this has meant incredible demands have been placed on energy and other resources. Although less urbanised than many countries, there is a staggering number of large cities in China. Currently, China is ranked the second largest economy in the world, with some pundits suggesting that by 2030 it will be the largest economy. What is important, however, is that China is undoubtedly the key to the fortunes of the global economy for the foreseeable future. And certainly also there is plenty of upside in China. Currently their per capita income is around the level of that in Australia in the 1950s. However, arable land remains a constraint. Much of the country is unsuitable for cultivation and agricultural production, and this fact is being exacerbated by the urbanisation that is taking place and which we will discuss shortly. When people think of China, perhaps they may think of Beijing, Shanghai, or even Guangzhou, which is just over the border from Hong Kong. However, as we noted earlier, there are many big cities in China. These key second-tier cities, so-called, and the regional centres around them have been clearly identified by the government and are central to China's ongoing development strategy. Each of these regions or centres has its own characteristics and particular comparative advantages. Hunan, for example, is a centre for manufacturing, metals and timber, and of course food. Jilin is a large grain producing area. rich in minerals, and with the auto industry and pharmaceuticals. Shandong is a big wine area. Hong Kong we don't specifically address in our discussion here. This is a special administrative region, along with Macau, and was ceded back to China in 1997 by the British. Hong Kong operates under a different political and economic system to China. It does, however, have a special economic and trade arrangement with the mainland. For those wanting more information on these cities and regional centres, they're advised to go to the website which is shown at the bottom of the map, the australiachina.com.au website. As noted earlier, China ranks number 2 in terms of the rankings of global economies. Australia, meanwhile, ranks around number 12. When we look at per capita GDP, or if you like, average income, despite the strong growth and despite the large economy, China ranks relatively low. Again, this is suggestive of the upside of the economy. China's per capita GDP growth has been impressive, with GDP per capita tripling since 2002. We should note, however, that per capita income in the western part of the country is much, much lower than in the cities and the coastal areas. And it is this part of the country which China is focusing on as it attempts to move forward. Looking at China's GDP growth over time, we can note that despite the sustained performance, there is still a matter of economic cycles. These have been much more muted, of course, since the move to a market economy. With the market mechanisms now in place, it's much easier for governments to try to manage those sorts of cycles. However, economic macro management is still a work in progress in China. In particular, monetary policy and financial market deregulation are very much front and centre in terms of the reform agenda. If we look at China's GDP growth relative to the rest of the world, we can see how China got through the GFC, or the global financial crisis of 2009, relatively unscathed. Growth has trended down, however, following the subsequent pickup in 2009. In fact, it was China's stimulus in response to the global crisis that allowed Australia to avoid going into recession, and we'll pick that up in later discussion. Looking at the macroeconomic economy of China, we can identify some key features which have been underpinning the success to date. The growth story in China has been one that has been driven by investment and by exports. Chinese households, however, have a very high savings rate relative to other economies, and as a result of this, domestic consumer demand has not been as important as a spur to economic activity as we see in other economies. High domestic savings, around about 50% of GDP, means that domestic consumption in China is around 40% of GDP, and this is very low by international standards. The economic model based on trade and investment has resulted in structural imbalances and is not seen as sustainable for China moving forward. More stimulus is needed for the private sector and for household consumption. More financial sector deregulation is also required. The current government is embarking on a major shift in the country's economic strategy. The focus now includes greater urbanisation, a fostering of growth in the inland western part of the country, and efforts to reduce financial risk. And this is tied in also very much with financial sector deregulation. This financial risk in China is evident in these graphs of the residential property market. The booming property bubble in China is just one expression of how households are responding to the lack of domestic investment opportunities. It's also in part tied to the lax credit controls which were part of the stimulus package following the GFC, and also due to the way that land auctions are controlled in China, where local governments have a monopoly on land release. Looking at credit and money supply growth, we see that there was a big boost to credit at the time of the GFC. This gave a boost to output in China, and as I mentioned earlier, helped Australia as a result. This credit stimulus is being wound back now, and China is settling into a much slower growth trajectory, around 7.5% per year rather than the 10% per annum which was evident over the last decade or so. However, a country growing at 10% a year doubles in size in about 7 years. So 7.5% growth now would be equivalent to past rates of possibly around 10 or 12%. A major refocusing and rebalancing of the economy is now underway with the new leadership recently installed in China. Key aspects of this include rapid urbanisation, a slower growth trajectory, and an emphasis on innovation and productivity. This has profound implications for what China will need and what it will be producing into the future, and will be of huge significance for Australian businesses. In China, about 20 million people move each year to the cities. The urbanisation rate, however, at 50%, is still well below that in many developed economies. The ageing of the population in China is another piece of the jigsaw puzzle. The shrinking workforce towards 2020, a decline in the productive population, those aged 15 to 64, further highlights the importance of a shift to an intensive growth model. The shift to the hinterland and the search for untapped labour will perhaps help temper this trend. However, the shift does suggest a growing demand in areas like healthcare and related service and biomedical industries. A look at China's trade performance highlights its contribution to the growth economy. China is the world's #1 exporter and importer, and since joining the WTO, or the World Trade Organization, in 2001, exports have doubled, and both exports and imports have each accounted for about 10% of world trade growth since that time. Similarly, the inflow of FDI, or foreign direct investment, has been significant in China. China is now the largest recipient of foreign direct investment after the United States. What is emerging now, however, is the importance of China as a source of foreign direct investment, with companies and also high net worth individuals increasingly seeking investment opportunities offshore. And this will be a topic for discussion in later sessions. As noted, looking at the global export rankings, China is #1. Australia is down there at number 21, but China is ahead of the USA, Germany, Japan, and the major European players. If we look at China's trade partnerships, we know that China is a major exporter to the US, but the importance of Hong Kong in that list there is perhaps a little bit misleading. This hides the fact that much of the trade with Hong Kong is en route to third countries. Looking at China's trade partnerships, we see that the US is China's main export market. The importance of Hong Kong in that list is a little bit misleading, however. It hides the fact that much of this trade is en route to third countries. China, as a trading country, is very tied into the Asian economic network, both as a final market for products, but also it views the rest of Asia as a source of components and intermediate goods. China does a lot of value adding and then exports on the final product. While still of huge importance, China is looking to reduce its reliance on export markets and to drive domestic growth as it tries to stimulate the domestic consumption aspect of the economy. In terms of the products that China trades, we'll be looking at this in more detail in a later session. Certainly, on the export side, China's exports are dominated by manufacturing, particularly electronic and other machinery goods. On the import side, very much a minerals and energy story, and also high-tech equipment. Finally, a brief word on exchange rates. Looking at the RMB, the Chinese currency, we should note that this is a key variable in all of China's dealings with the rest of the world. The RMB is a managed currency and for a long time has been held artificially low, which made life very difficult for China's trading partners. China's exports were encouraged and it made it very difficult for those exporting into China. Over recent times, the Chinese currency has been allowed to strengthen by the authorities. This is favourable for Australian exporters and also for those competing against Chinese exports. The relative movements in exchange rates will be an important component of how Australian businesses fare in the Chinese market. So what we see now is an economy which is a global powerhouse, the world's leading trading nation, one that currently is the second largest economy in the world, but one which is going through a serious restructuring and rebalancing of its economy. It's moving out into the hinterland, into the western parts of the country, with massive plans for restructuring. This presents great opportunities as well as great challenges for the authorities